Welcome back to the Paisa Forever channel. If you have been tracking the markets or just planning a family wedding recently, you know exactly why we are having this conversation today. We have officially breached a psychological barrier that seemed impossible just a few years ago. As of January 2026, gold prices in India have crossed the 1,40,000 to 1,45,000 rupee mark per 10 grams. Let that number sink in for a moment. 1.45 lakh. This surge is being driven by a mix of persistent global geopolitical uncertainty and the rupee continuing its complex dance with the dollar. But here's the dilemma facing every Indian household and investor right now. With prices at these record highs, is it too late to enter? And more importantly, if you do decide to allocate capital to gold, how do you do it? Do you buy the metal via ETFs? Do you bet on the companies selling the necklaces? Or do you take a higher risk approach and look at the miners digging it out of the ground? In this video, we are going to do a deep dive into the gold triad: ETFs, mining stocks, and jewelry stocks. We are going to break down the critical tax changes from the financial year 2026, the concept of operating leverage that makes miners explode in value, and why your local big brand jeweler might be making money even faster than gold prices are rising. Let's start with the boring but absolutely critical stuff first: the structural shift in how we are taxed. If you're still buying physical coins or bars for investment, the regulatory landscape has just shifted in favor of paper gold or financialized gold. Starting from the financial year 2026, there's a massive incentive to look at gold ETFs over physical gold, and it comes down to the definition of long-term capital gains tax, or LTCG. Previously, physical gold and ETFs were treated somewhat similarly regarding holding periods. But now, the rules have bifurcated. Gold ETFs now qualify for long-term capital gains tax treatment after just 12 months of holding. Compare that to physical gold, which you still need to hold for 24 months to qualify as a long-term asset. This is a significant change for liquidity. It means if you buy a gold ETF today and sell it a year and a day later, you're entering the long-term tax bracket. If you buy a gold bar, you're stuck waiting 2 years to get the same tax treatment status. For a dynamic portfolio in 2026, that 1-year difference provides a lot of flexibility. However, there's a catch, and it's a big one, that requires us to rethink our real returns. While the holding period has become attractive, the tax calculation has become stricter. Whether you're in gold ETFs or gold mutual funds, you now face a flat 12.5% LTCG tax rate without indexation. Remember the days when we could adjust our purchase price for inflation using the cost inflation index? That mechanism is gone for this asset class. You pay 12.5% flat on your nominal profits. What does this mean for your portfolio? It means inflation is now your personal problem, not the taxman's. If gold rises by 8% and inflation is 5%, you're paying tax on the full 8% gain, not just the real 3% growth. This forces investors to be much smarter. We can't just rely on gold simply keeping pace with inflation anymore. To justify the tax hit, we need assets that have the potential to outperform. And that brings us to the equity side of the equation, specifically the jewelry stocks. You might assume that when gold prices hit a 1.45 lakh rupees mark, Indians would stop buying jewelry. Historical logic suggests high prices curb demand. But the data from Q3 of FY26 tells a completely different story. The results from major players like Titan, Kalyan Jewelers and Senco Gold are nothing short of spectacular. We are seeing revenue growth figures of up to 51% year-on-year for some of these players. Why is this happening? There are 2 reasons. First, the Indian wedding market is incredibly resilient. Demand there is largely inelastic. But the second reason is where the smart money is looking: the shift to studded jewelry. Retailers are aggressively pivoting away from plain gold jewelry. Plain gold has low margins. You make a small making charge and that's it. But when you sell diamond and gemstone studded pieces, the margins skyrocket. This premiumization means these companies are no longer just a proxy for gold prices, they're evolving into luxury lifestyle brands. Even if gold prices stagnate, the margin expansion from selling more diamond jewelry can drive stock prices higher. If you're looking for a defensive bet that capitalizes on Indian consumption stories, this is where the data points. Now let's flip the coin. What if you want aggressive growth? What if you want to use this gold bull run to generate alpha? This is where we have to talk about gold mining stocks and a concept called operating leverage. Beginners often think if gold goes up 10%, the mining stock should go up 10%. That is not how it works. In a bull market, mining stocks essentially act like gold on steroids. Let me explain. Suppose it costs a mining company $1,500 to pull an ounce of gold out of the ground. If gold is trading at $2,000, they make a $500 profit. Now, if gold prices rise by just 10% to $2,200, the company's revenue goes up, but their cost to dig usually remains largely fixed at that $1,500 mark. Their profit jumps from $500 to $700. That's a 40% jump in profit from just a 10% gold price rise. This is why in 2026, with gold breaking records, global miners are delivering massive upside potential. They are cash flow machines in this environment. But here's the problem for Indian investors. Most of the big stable miners are in the US, Canada, or Australia. So how do you invest in them? If you want to stay strictly domestic, your options are extremely limited. We essentially have one pure-play listed explorer, Deccan Gold Mines. I need to be very clear here. This is a high-risk speculative bet. Unlike Titan, which sells products today, or global giants like Barrick that mine tons of gold today, Deccan Gold is largely a play on reserves and discovery. You're betting on their ability to find and commercialize gold deposits in India and Africa. It's volatile. It can swing wildly based on regulatory approvals and exploration news. This is not the part of the portfolio that ensures you sleep well at night. This is the speculative corner. If you want that operating leverage stability, you have to look outside India. And thankfully, the Budget 2025 gave us a breather on this front. The government raised the tax collected at source or TCS threshold to 10 lakh rupees. This means you can remit up to 10 lakh rupees per financial year for foreign investments like buying US-listed gold ETFs or stocks without having that 20% TCS deducted upfront. For most retail investors, this opens the door to global gold exposure without the immediate cash flow crunch. If you want that operating leverage we discussed, looking at international markets is now much more accessible. So let's bring it back to the execution. You've analyzed the market and you just want exposure to gold without the volatility of miners or the specific risks of jewelry stocks. Should you choose a gold ETF or a gold fund of fund? The rule of thumb for 2026 is simple. If you have a demat account and you're comfortable buying in lump sum during market hours, gold ETFs are generally superior because they have lower expense ratios. You're buying the units directly on the exchange. However, if you're a disciplined investor who wants to automate everything via SIPs, you should look at gold fund of funds. You don't need to open your demat account every month to execute a trade. You can set up an SIP for as low as 100 to 500 rupees. Yes, the cost is slightly higher because you pay the expense ratio of the fund of fund plus the underlying ETF, but the convenience of automation usually outweighs the cost for smaller SIPs. Before we wrap up the strategy, let's take a moment to do a reality check on 4 common myths that are circulating in 2026. Myth number 1 is that jewelry is a good investment. The reality is that jewelry is great for consumption, but it's inefficient for investment. Between the 3% GST, the 10 to 20% making charges, and the deduction for wastage when you eventually sell, you're starting your investment at a significant loss. You need gold to rise 25% just to break even. For pure investment, ETFs or sovereign gold bonds are mathematically better. Myth number 2 is that sovereign gold bonds are gone forever. This is false. While the government has paused new issues, existing SGBs are trading every day on the NSE and BSE. You can still buy them from the secondary market. And here's the kicker. If you hold them to maturity, the capital gains are still tax-free. Myth number 3 is that digital gold on payment apps is the same as an ETF. It is not. Digital gold is not fully regulated by SEBI in the same way ETFs are. Furthermore, you still need to hold digital gold for 24 months to get long-term capital gains benefits, whereas ETFs now give you that status in just 12 months. And finally, myth number 4 is that mining stocks always go up when gold goes up. As we discussed, mining is a business. If fuel costs rise or labor unions strike or a mine collapses, a mining company can lose money even if gold is at an all-time high. When you buy a miner, you're buying a business, not just a metal. So how do you construct your portfolio in 2026? Gold acts as what we call crisis alpha. When the rest of your portfolio, your tech stocks, your small caps are bleeding red, gold tends to hold the line.
Most data-driven financial perspectives suggest a strategic allocation of 5 to 15%. You might lean towards 5% if you're young and aggressive, focusing on equities. You might lean towards 15% if you're nearing retirement or are generally risk-averse. The goal is not to chase the 1.45 lakh rupee price, expecting it to double overnight. The goal is to use gold as insurance for the rest of your wealth. Whether you choose the stability of ETFs, the consumption growth of jewelry stocks, or the leverage of global miners, make sure it fits your risk appetite. We've covered a lot of ground today, from tax codes to mining mechanics. If you found this breakdown helpful in navigating the 2026 market, make sure to follow for more deep dives.
Disclaimer: this video is for informational purposes only and does not constitute financial advice. The market involves risk, so please conduct your own research before investing.